Good morning, everyone, and welcome to our Roots to Results webinar series hosted by Manitoba Crop Alliance. My name is Darcel Graham, and I'm the Chief Operating Officer here with Manitoba Crop Alliance, and I'll be your facilitator for today's session. This is series number 2 of our 5 webinar series exploring farm business management topics that can drive measurable outcomes for your farm. We're so glad you've joined us today. Before we begin, I have a few housekeeping notes. Today's session will last about 60 minutes, including Q&A at the end. Please feel free to submit your questions anytime using the Q&A feature at the bottom of the screen. We'll gather those and address as many as we can after the presentation. This session is being recorded and will be available on MCA's YouTube channel in the near future. MCA will also be producing wrap-up articles that will be featured in our monthly e-newsletter summarizing the key takeaways. Now it's my pleasure to introduce today's speaker. Edith Frison is a tax specialist with MMP in Brandon, serving primarily agriculture clients for the past 2 decades. She gets to know her clients to clearly determine their needs, then design a plan to help them successfully move forward. Edith works closely with her clients to set up their operations in the most tax-efficient manner with the goal of minimizing their tax burdens. Her services include corporate reorganization, farm planning, succession planning, and will review. Edith graduated with a Bachelor of Business Administration from the University of St. Anne in 1999. She's a chartered professional accountant, qualifying as a chartered accountant in 2009, and completed the Canadian Institute of Chartered Accountants Tax Specialist Program in 2010. We're thrilled to have Edith join us today to share insights on the key elements of farm succession planning, focusing on securing the future of your agriculture business for the next generation. With that, I'll hand things over to Edith. Welcome, Edith.
Hi, everybody. Can you see my presentation? Oh, no, not yet. Can you see my presentation now?
Yep.
So today I've kind of collaborated with my colleagues here in Brandon who do kind of the same work that I do. And we've come up with kind of the top 10 traps or tips that we see for succession planning for agriculture clients. My name is Edith Frison, like Darcel said. I'm a partner here in our Brandon office, but I will travel pretty much anywhere to meet with you and have coffee and just discuss or, visit your farm, see what you've got on the go. Always happy to go out for a farm visit. MNP has 13 offices in Manitoba, and this is our permanent offices. Most of these are pretty much full-time. We also have other offices you might see in your small community that are open maybe one day a week or an afternoon a week. If you are ever, have any questions about anything I say, feel free to stop by. Anybody in those offices would be able to answer your questions. So the first thing that we see when we're talking to clients about their farm succession is having a proper will in place. So I'm going to talk a lot about death today, and I'm going to talk really kind of about mom and dad relationships. And typically I talk about dad dying first because that's really how it usually goes. Don't be offended or anything like that. It's just kind of the way I frame it up so that everybody can understand. So when you die, you're deemed to dispose of all of your assets on death. And the rule really is at fair market value, unless we can find some other provision in the Income Tax Act that would lessen the tax burden on disposing of that asset. One of the things we see is the biggest downfall to a sound succession plan is an outdated will or no will at all. If you don't have a will at all, your estate has to go to court. Your assets are split up by however the judge feels it's appropriate. And typically what he or she will do is just split your assets evenly among your children, whether they're farming children or non-farming children. If you don't have that proper will in place and the judge and the lawyer decide, hey, we're just splitting everything equally among your children, you can imagine how much infighting that is going to create. Now all of a sudden, farming daughter has to farm with her non-farming brother. He's in there, he's making decisions about her farm and what she does. And maybe he's never even worked on the farm for one day in his life. So you can just imagine how much infighting and how unharmonious that would be after you die. It also leads to significantly higher legal fees and usually income increased income taxes owing by the estate, because we don't plan into using all the special tax provisions that are out there for farmers. And as a result, the estate will usually owe more taxes. If you have a will in place, you should look at it every couple of years to make sure that it's still meeting all of your objectives. You're still happy with the children who are getting the farm or getting the non-farming assets. Every couple of years, it gives you a chance to kind of make some changes. Maybe you were getting along with your son a couple of years ago, and now you're on the outs with him. So it gives you the opportunity to change up your will every couple of years if you look at it. My experience when I'm talking to lawyers about wills, lots of people will go online and get some kind of will kit, and they'll jot down all their notes and have something in place, and they think that's actually a decent will that will stand up in court. If you have one of those, I'm not sure that that is the case. Usually wills aren't really that expensive, and those will kits that are available online are probably about the same price as going in, meeting with a lawyer, and making sure that they are rereading all your notes and making sure that things will line up exactly the way you anticipate they will line up when you have written your will yourself. So it's probably a good idea if you have one of those wills that's kind of written on paper or a napkin or whatever, to take it to your lawyer and make sure that it's going to stand up in court. I definitely believe it will be worth the fees they charge you. A couple other tips for having a good will. You want to keep it simple and as clear as possible. We can potentially put in some rights of first refusal for farm property to non-farming children. For example, we could do a right of first refusal to son. He's a non-farming child, but you don't have any other assets to leave him. So you leave him one parcel of land. So you want to ensure that if his sister, who's the farmer, wants to buy that land, she has the opportunity before he sells it to a third party. That's a right of first refusal. She gets the right to buy it from him before he sells it to a third party, keeping the farm together and the land together that the family has had likely for generations. Another thing that's really important once you draft your will is you want to chat about it with your children prior to your death. And this helps your children not have hard feelings after you pass away. You give them the opportunity to know why you left certain assets to certain children, and you give them the opportunity to ask you questions or contest or, have a discussion about what you're leaving each child prior to your death. Always keep in mind that assets must vest indefeasibly with children in order for the transfer rules to apply. So what that means is the children have to end up owning the assets. We often run into cases where dad will want to put in a bunch of caveats about, well, he can't get the land unless he does this or unless this condition's met. Lots of times if you put a bunch of gobbledygook in there like that, it will actually lead to adverse tax consequences. So we really want to make sure that everything vests indefeasibly with the child that we want to receive that asset. Capital gains exemption. So this is a allocation that's made to every Canadian resident taxpayer, and it can be used in your life or on death. And I'm not sure if everybody was following all the government or all the political stuff last year, just before the election, but this was definitely in the news, and it was increased to 1.25 million. If you have a transaction, 1.25 million. If you have a transaction after June 24th, which why they pick crazy dates, I'm not sure, but June 24th, 2024, you can use this 1.25 million. So if your transaction was prior to that, you only had $1 million available, or $1,016,000 because it had been indexed, but you had a much less, a smaller amount available. So after June 24th, we can use this 1.25 million. There was lots of different conversations or different information kind of disseminated last year throughout the year about the inclusion rate. Like, was the capital gains inclusion rate going to be 50% or 75%? And even this year, I kind of got caught up in what happened with all that. Did the rules actually go through? Is the inclusion rate going to remain at 50% or not? I did a bunch of research, and the answer is yes. From January 1, 2026 on, the capital gains inclusion rate will remain at 50% unless there is a change in the legislation. So that's super encouraging, and it will be indexed starting in January 1, 2026. So we'll get a little bit of a bump here in a couple of weeks, actually. So good news for Canadians. In the year, or if you want to use your capital gains exemption, your assets have to qualify for capital gains exemption use. And these rules are super complicated, and probably what I spend most of my time doing, trying to make sure people are on side or figure out whether or not their assets do qualify for exemption use. There's a couple of things that farmers can use their capital gains exemption on that wouldn't necessarily be widespread. One is land. But in order for land to qualify for capital gains exemption use and intergenerational transfer rules, we have to look at how the land has been used in the past. And it's often confusing because there's two sets of rules here. There's the capital gains exemption rules, which depend on what year you acquired the land. And there's the intergenerational transfer rules. And I'm going to talk about those a little bit later, but they're different than the capital gains exemption rules when it comes to land. So I guess what I'm trying to say here is the rules are complicated when it comes to land, and you may want to consult a professional in order to make sure you're getting good advice if this is how you're planning to structure your will, that you're going to use your capital gains exemption on death. Shares of a qualified family farm corporation qualify for capital gains exemption. The asset mix on the balance sheet has to be analyzed. You can never have more than 10% inactive assets. And I'm going to get into that in one of my other slides, so I won't dwell on it right now, but just kind of introduce that concept. And shares of a commercial corporation may also qualify. Those rules are complicated as well. And you do have that 10% inactive asset cap that you can have in QSBC shares in order to use your exemption, so watch that. If you have a holding company and that owns your farm and you want to use your capital gains exemption, those rules are really complex and you really have to consult a professional in order to make sure you're on side. When we talk about capital gains exemption, and accountants do this all the time, we talk about a tax-free capital gain and you don't have to pay any tax. That's kind of true and kind of not true. In the year you trigger a capital gain, you could have old age security clawback, because the way those calculations work is it takes all of your income and then determines how much old age security you're entitled to. So if you had a year where you had a giant capital gain, and then you use your exemption, it doesn't deduct exemption from that calculation, so your old age security will be clawed back. Or if you're younger and you have small children, your child tax benefit could be clawed back. So we really have to watch those numbers. That could be significant for certain clients. So sometimes we pick a different year, or we pick a different time when we won't impact those numbers as dramatically. In the year you use your exemption, you could also have a pharmacare deductible change. So again, the calculation for pharmacare is done based on all your total income and doesn't take into account the fact that you're using an exemption. So that pharmacare deductible can skyrocket, or your nursing care home fees will also be changed because you have that income inclusion. This is the biggest, alternative minimum tax is the biggest kind of trap that I see when it comes to capital gains exemption use and triggering a capital gain in general. So when we file your personal tax return, there's a whole calculation going on in the background, in the software and in the legislation, where it says that you have to pay a minimum amount of tax every year. So if you have a giant capital gain, then this alternative minimum tax will kick in. On $1 million, let's say, or 1.25 million, it could be like 60 to 70,000 bucks. So it's not for the weak of heart. It's owed with your taxes in the next year, so you have to cash flow it. It can often be a cash flow issue, especially if you're using your capital gains exemption and not receiving cash immediately from the purchaser. How it works is we owe it and we pay it in with our taxes. And then as we owe tax for 7 years after we've paid it, we can draw down on that balance. Now, it's not dollar for dollar. Again, there's another calculation as to how you can use it up. But one thing to keep in mind is only certain types of income will draw down on that balance that you've already paid into CRA. So things like farming income or employment income, they use up alternative minimum tax credits very quickly. But if you have things like pension income or dividend income, they don't. So sometimes you can't get all the money back within the first 7 years. And now all of a sudden that became a pure tax. So it's kind of a hidden tax. People don't really see. I've definitely had sales, like I had a sale in Dauphin just not that long ago, where it was significant amount of profit, like a significant capital gain. Like they got like $20 million, let's say. But they owed over $300,000 worth of alternative minimum tax each, like a whole family. And in order to get that kind of AMT back, they would have had to have like $300,000 to $400,000 worth of eligible income for the next 7 years. And that just wasn't going to happen because they didn't really have anything else to generate that would generate income. Excuse me. So we had to change our plan. Fair versus equal. In some cases, in some families, non-farming children believe that they should receive equal value of the parent's estate as the children that are involved in the family business. I feel like if farming parents were to proceed in this manner, it would often put the future viability of the business in jeopardy or the farm in jeopardy. Most farms can't cash flow that kind of cash to a non-business child. So I think when parents are planning their estate, they have to think about is equal fair or not? And this is definitely a decision I wouldn't want to have to make for my own children. But in my mind, I feel like the children that are receiving cash may end up with a smaller value or a smaller amount than children that are receiving farming assets. You have to consider both the value that you're giving them and how it's going to be repaid or paid out to those non-farming children. Some options we often suggest for non-farming children would be for parents to leave non-farming assets to those children. So things like cash, non-registered investments, RSPs, which I'll get to in a second, maybe the TFSA or the house. We could go ahead and give the non-farming child some non-participating, non-voting preferred shares. If we were to do that, it's a good way to, equal that, make that fair and equal sort of balance out. I would definitely suggest that we have some kind of shareholders agreement in place in order to restrict the amount of shares that non-farming child could redeem on an annual basis. So let's say the parents decide that the farm could cash flow $10,000 a year. We put that in a shareholders agreement and we make sure that that's signed. That way the non-farming child can't demand their $1 million worth of shares all at once and then bankrupt the farm. So there's a few caveats or a few strategies that we can put in place in order to protect the farming child, because although you're giving them a very large sum of value, they have no cash. So or typically they don't have a bunch of cash. And so we have to make allowances for that. Sometimes we will actually suggest getting life insurance if mom and dad are still in good health and we think that those premiums are affordable, then we can leave the life insurance proceeds to the non-farming children, and then the farming child can get the farm, and then nobody has to cross paths. They're sort of separate and everybody's considered equal. Non-resident children. We see lots of this with land kind of along the border. So if you want to pass your farmland to children or shares of your family farm corporation to a child, they really should live in Canada. Like, that's my suggestion. If your child is a non-resident, you as a parent cannot transition that farmland or those shares to them at cost. It has to go at fair market value. So if it goes at fair market value, we're often using those capital gains exemption rules, and then we're into like the OAS clawback, maybe some AMT. If we're leaving land to somebody who's not in Canada or somebody who's not a farmer, then we could have land transfer tax, which is about 2% of the value of the land. So you'd have to talk to your lawyer about that. That non-resident child will not have access to their capital gains exemption on that inherited property if it's ever sold in the future. Depending on where they live, it might have some major tax implications. Like if they live in the States and they sell the land for capital gain, it can have some major tax implications to them in the States. There are some questions that I've had around can a non-resident own farmland in Canada? I think they can own up to 40 acres, no problem, but I do believe there's some restrictions on who can own farmland in Canada. I've been through those rules. If you were a resident and you could be a resident again, I think there are some loopholes there, but we would definitely have to explore that if you were going to leave your land to a non-resident child. Non-resident children also have a withholding tax that they have to pay on any rental income that they receive. So if your non-farming child is renting to your farming child, it becomes a little bit more complicated on an annual basis when that rent gets paid, and then when the property is sold. So again, the non-resident children, it might be more efficient or easier to leave them cash and investments or maybe shareholder loan. And we often tell parents to keep enough capital gains exemption kind of in their coffer, like held back. We hold back enough capital gains exemption so that parents will have enough exemption to offset that gain when they transfer the property to a non-resident child. Having significant RSP balances on death. So I know we've scrimped and saved and we've put a bunch of money in our RSPs. And we've taken advantage of kind of lowering our marginal tax rate, while we're young. And the thought was always that we would be able to pull that money out at a lower tax rate because we would be retired and have less cash kind of in our later years. But what we're seeing right now is that parents have sizable balances in their RSP accounts, to the point where I am concerned about whether or not they can get all the cash out of that RSP in a tax efficient manner. One thing that will happen when you die is your RSP will transfer to your spouse, no problem. But when you and your spouse, the last to die, then that RSP is deemed to be cashed in, and it's cashed in at its fair market value. And anything, kind of over and above that 200,000 would be taxed at 50%. So that's definitely not the tax outcome that we wanted. We really wanted to pull that money out at lower tax brackets than 50%. There's really no way of avoiding this other than withdrawing your RSPs. So our advice is usually meet with your investment advisor, meet with your accountant, and let's come up with a plan to withdraw your RSPs, as quickly as we can, but still staying within some reasonable tax rates. Lots of strategies exist out there. Like potentially if you have a company and you're paying yourself a wage or salary, maybe you stop doing that and you start drawing down on your RSPs instead. Or maybe you pull down your RSPs and put them in your TFSA. A TFSA does not have tax on death because it's a tax-free savings account. Number 5, adding children or spouses to land title. Now, this really was the flavor, I'm going to say, even prior to 2024 or prior to 2020, because we wanted to avoid probate. So we'd add either our child or our spouse to land title so that everything would transition to them, outside of probate. But probate was eliminated on July 1st of 2020, and it was really only ever 0.007 cents for every $1 of value. So I'm not sure that it was necessary, if you want to know the honest truth. When we added our spouse or our child to title, it did not have any impact for tax purposes. It was only for land. It was only for legal purposes. So it does not mean we can access an additional capital gain exemption. If you've added somebody to title, the whole gain will attribute back to you. One thing I think is kind of, a hiccup if you've added your children to title. If you decide to change your estate plan in the future as to who's going to get that parcel of land, you have to actually go down and change the title, and the child has to sign off on the documents. So that's all well and good if everybody's getting along. But if people are not getting along, it can be very difficult to convince that child to go down to the lawyer's office and sign those documents. If the child who was added to title is not a farmer, then land transfer tax will apply. Any of the child's creditors can access that land in the event of bankruptcy, a lawsuit, or potentially a breakdown in marriage. That's the one that scares me the most. If your child is, well established, 40 years old, maybe it's one thing, but if we don't know whether or not they're going to be on the straight and narrow for the future, I'm really concerned about adding them to land title. If you've added your children to land title, you may have potentially created a T3 or a bare trust, and now you need a legal document to support your CRA filing. So that was a huge hullabaloo about 2 years ago, where every T3 for a bare trust had to be filed. And we actually want legal documents to support the relationship between the parents, the child, and the land. Although we're getting ready for this kind of filing and CRA is saying it's coming, it's not applicable for 2025, so we'll worry about that in 2026. Rental years versus farming years. So like I said before, for intergenerational transfer, so this is if I'm going to transition my land or give my land to the next generation at exactly what I paid for it, absolutely no tax consequences to me, then the land has to be used primarily, which means more than 50% for farming. So CRA interprets this used primarily to refer to the number of years farmed versus the number of years rented. So one example would be land was farmed for 20 years and then rented for 19 years. That qualifies, but we should be gifting it today because it's not going to qualify next year. If the land was farmed for 20 years and then rented for 21, it does not qualify. And what that means is the land has to go to the children at fair market value. And that would be taxable if you don't have any capital gains exemption remaining. When I talk about farming, I talk about who farmed the land, who qualifies. So land was farmed by who? It had to be farmed by a grandparent, parent, or child, and that means all the way back to great grandparent. So one of the things that I suggest, and it's one of the things, if you take anything from this presentation, it's go home, write down each legal land description, write down how many years it was farmed and how many years it was rented. This can be very important information upon your death. And if we don't have it written down or have any evidence, then our default is to say it was rented longer than farmed, and we don't let people use this intergenerational transfer rule. So go home, write down who, where it came from, all the history that you know about the land, what you paid for it, how it transitioned, everything. One trap that you can fall into when I'm talking about who farmed the land is siblings. If land is farmed by siblings, that does not count as farmed by a qualified individual. And this usually only occurs if the land is purchased by the siblings. If the land was farmed by mom and dad, we might be able to get away with using exemption and using the intergenerational transfer rules. But if the land was purchased by siblings and then farmed by them, it might not qualify for any favorable tax treatment. Land has to be considered controlled by a qualifying individual. So if brothers or sisters own the land 50-50, nobody controls, and that kicks you out of these rules. Siblings are not qualified to each other. So if you own land jointly with your sibling, you should be asking your accountant if they think it will qualify. If they don't think it will be qualified farmland, then we can fix it. We have lots of options to get it back on side. But again, we have to do that before you pass away. So if you're doing that and you pass away, then we might have to give you a shock to keep you alive for another couple of years in order for the land to qualify before it transitions to the next generation. Inactive assets inside a corporation. So for shares of a corporation to qualify for the exemption, and I sort of alluded to this before, we need all or substantially all of the assets inside that corporation to be used actively in the business. Inactive assets are things that you don't use on a daily basis in order to generate farming income. So that would be excess cash, like things like GICs, investments, any non-farming business assets or non-qualifying land, any notes receivable. These inactive assets can be a bit sneaky. For example, I had a scenario where I wanted to use exemption. I looked at the asset list and it said land. All the land was lumped together. I thought it was all farmland, but once I get in there and started asking the client about, well, where is this land? One of the parcels of land was in Riding Mountain National Park, and it was being held to construct a cottage. That's an inactive asset. It was in no way, shape, or form being used to generate farming income. They just bought it in the corporation because the corporation had the cash at the time. A receivable from another corporation may or may not be an active asset, or it could be an inactive asset. We really have to do an analysis of that other corporation. So those are a couple of sneaky inactive assets that can throw you offside and you don't even realize. So if you were to pass away, all of a sudden now your farm is offside. And something that could have transitioned, if it was a $10 million farm, it could have transitioned for nothing. Now we owe $2.5 million to the tax man. For example, the farm I was talking about had $10 million worth of assets. If that land was worth $22 million, the land in Riding Mountain National Park, all of a sudden we have 20% inactive assets. We don't qualify. Again, if the individual passes away holding shares in a corporation that doesn't meet the tests and they do not have a spouse to transfer the shares to, then there's a deemed disposition at fair value on death, and that's taxable. We do, again, have strategies to get the company back on side. Maybe even it's a one-time. So is it like I did a tax reorganization to pull out that Riding Mountain National Park land, and now all of a sudden that farm is back on side. The land in Riding Mountain National Park will be taxable when it transitions to the next generation potentially, but at least the $8 million farm is safe and can be transitioned for nothing. Farm partnerships. This is not often overlooked. I want you to think about your operation. Is it a sole proprietorship for real, or is it a partnership between you and your spouse or you and your brother? A partnership can be 50-50, it can be 70-30, it can be 99-1. And the reason I'm bringing this up is because for tax purposes, being in a partnership is actually better than being a sole proprietor. If you're a sole proprietor and you die, you're deemed to dispose of all your assets on death. And the biggest risk I see here is inventory. Usually its value is super high, like probably it could be anything, but it's usually pretty significantly over the $200,000. And anything over $200,000 will be taxed at the highest marginal rate, which can be 50%. So if instead of holding a sole proprietorship, you contribute your inventory and other assets to a partnership, and then that partnership farms for 2 years, you can avoid this estate tax liability on that inventory. So essentially what you've done is you've traded inventory and farming assets that are potentially taxable on your death for partnership interest, which actually qualifies for capital gains exemption and intergenerational transfer rules. There's also provisions in the Income Tax Act that will allow an estate to farm as part of a partnership, as a partner in a partnership, which buys us the time we need sometimes when you die to deal with the taxes that are going to be owed inside that partnership. If you ask me, I think every farmer should be at least in a partnership, not a sole proprietorship, and earlier is always better because you can split the equity as the farm grows. So we have access to a couple of capital gains exemptions potentially instead of only one. You can be in a partnership with your wife or your husband, with your mom or dad, or we may even have a solution if you're a bachelor. It can also be very useful if you have a good year. We have the opportunity to create shareholder loan using your capital gains exemption by selling your partnership interest to a corporation. So it's a very, very tax efficient way to get into a corp. Buying parents' shares in a company. So prior to Bill C-208, which is a fairly recent, like maybe 2021, parents could not use their capital gains exemption on shares in a company if they wanted to sell them to their children. It would be considered a dividend, and that would be, at 46% usually. So we usually avoided selling shares or trying to get shares from mom and dad to their children. But now, since Larry Maguire's bill, children can buy their parents' shares in a company and use corporate funds to pay out their parents. And the benefit there is parents can use capital gains exemption. We do have to follow all the rules. And usually when I think about C208, I think about a parent-child deal looking similar to a deal that would be struck between two third parties. So in this instance, the shares would have to be QSBC or QFP. That's usually what we do if we were doing a third-party sale. The children have to incorporate a holding company. There's some criteria that have to be met over the 3 or 5 years after you do the deal. But basically is mom and dad are getting out and son or daughter is taking over, which would mirror a third party sale or a third party deal. So that's really kind of what we see. Here's my quick recap of the top 10. You need to get a will in place and look at it every couple of years, maybe every 2 years, every 5 years, something like that, and consult a lawyer to make sure that it's a sound document. You have to plan into using your capital gains exemption, make sure your assets qualify, make sure you know which assets you have that could qualify, and do a bit of research and plan into how we're going to use that on your death. Fair is not necessarily equal. I don't envy anybody who has to deal with farming and non-farming kids. But we usually want to try and equalize with non-farming assets if possible, because we want to try and keep the non-farming children out of the farm. Non-resident kids, I also suggest let's equalize with non-farming assets, or maybe let's not leave them land, let's leave them something else if at all possible. Significant RRSP balances on death will be taxed at 50%, so we probably want a strategy to draw down that balance a little bit quicker. Adding spouse or children to land title, let's just explore all options. Is this really the best idea or the best way to achieve our goal? Rental years versus farming years, I want you to make some notes about your land by legal land description. Where did it come from? Who got it? Who farmed it? Who rented it? How did it transition from one generation to the next? Did it ever go to the bank? Did it ever go to a sibling? All those types of things are very important notes that we need when we're looking at whether or not the land will qualify. Get any inactive assets out of your company, get those out today. They can really cause us lots of grief if you pass away with those in your company. Consider a partnership or consider selling shares to your children. So my conclusion here is, like, we got to know the rules and plan accordingly to make sure we can take advantage of them. Families who are proactive in planning usually have better tax outcomes when somebody dies than those who don't. Is there any questions?
You bet. We have one question that has come in. The question is, can you talk about the life interest versus remaining interest in farmland when adding kids to the title? What would you recommend to make transitions easy so mom and dad keep the rental income until they pass away or go into a nursing home?
Okay, so that is a very complicated tax transaction, and I actually don't usually do it. One of the reasons I don't like to split into life interest and remainder interest is because you need to have a value of that life interest. And if you want a real value of that life interest, it needs to be done by an actuary. And then that's what mom or dad dispose of the life interest at on their tax return. The remainder interest is always worth nothing. So by dividing it into those two separate kind of concepts, you do achieve the goal of when you pass away, the land goes to that child. You keep the rental income while you're alive, but it's a very expensive endeavor. So usually what I would say is, in your will, leave specific quarters of land to specific children. Like, spell it out. I'm going to leave section or quarter section, 15, 10, 12 to Edith. I'm going to leave this other section to her sister. I feel like lots of times that achieves the same goal. The land goes to that child upon your passing. There's really no ifs, ands, or buts as long as it's spelled out in the will, and we avoid all the complication of dividing life interest and remainder interest concepts on somebody's tax return.
Thank you for that one. We have another question that has come in. When you say make notes on rental years versus farming years, how formal do those notes have to be considered valid?
Well, as time goes on, I feel like CRA has better access to digital information. But for the past, usually when CRA asks, usually as long as we respond quickly and we have something formal that not super formal, but even like a spreadsheet or notes in a Word document that kind of spell out who owned the land and why we think it qualifies, they usually accept that and move on. But when we don't have anything, that's when we run into problems. I've actually sent a guy out to a coffee shop in Deloraine one time where he had to ask kind of the patrons, do you know when my grandpa farmed this land? Which he got all the information he needed, and we submitted that to CRA and they didn't contest it. But that's kind of how vague or how much support we actually had for the claim.
Okay, thank you. Another question has come in. With the price of land skyrocketing, is it strengthening the farming sector?
Oh my gosh, I don't know. Is it strengthening the farming sector? I don't know. I'm worried about how much land costs and how that's prohibiting folks from investing in other areas of the farm. Like I'm sure everybody wants to acquire new land, but you're going to need equipment and machinery and all the borrowing that has to take place in order to purchase that land. Those numbers scare the life out of me personally.
Very true. Another question here for you. So in regards to succession planning, what would you say are some of the first actions a farm family should take when they want to start a succession plan?
I think you have to take note, like start making notes about what you own as a whole. What are the farming assets you own? What are the non-farming assets you own? Who are the children? What do you think they should get? What do you consider fair and equal? Like that, and that fair and equal is the hardest decision to make. I think people struggle with that all the time. But if you don't know what you've got, it's hard to know how you're going to split it up. If you don't have a will, though, I would definitely suggest gather up as much information as you can about kind of what your assets are and get in and get at least a preliminary will. Something that says, like, it doesn't have to be perfect, but excuse me, dying with a bunch of value and no will is really like that is it's a real hassle and very expensive.
Another question here for you. So farmers have always been told to keep their farmland owned personally. Why? And is that still relevant today?
Okay. So yes, I believe that folks should try to keep their land held personally. And the reason I say that is because when you own your land personally, you have lots of flexibility. You can leave 1/4 section to each child. You could roll it to your corporation or your partnership. You can do whatever you want with it. It's a very flexible asset. But the second that it's rolled into a corporation, now what you're leaving children is shares or partnership interest, and now you're lumping them together or making children operate as one unit, and they have to make decisions together, things like that. But if you leave a 1/4 section of land, they can decide whether to sell it or rent it or farm it, or that it's their asset and they can do what they want with it. I feel like any land that's paid off or that you own free and clear, that's definitely the strategy. If you're going to buy new land, you're going to have to usually buy that land inside a corporation, or once again, you're not going to be able to afford to make the debt payments. Inside a corporation, up to the first 500,000, you pay 9% tax. And so in theory, you'd have a bunch of cash left over to pay down that debt a little bit faster than if you held the land personally. And so I feel like, any land being purchased for $1 million a quarter, you have to hold that in a corporation. I just don't see any other way around it.
So speaking on the same topic, so can you gift land to nieces and nephews? Does it have to be sold at value?
It has
What
to
if
go
they
at fair
don't pay
value.
you? Yeah.
It has to go at fair value. And there are promissory notes that are forgivable on death. So in your will, you might be able to have a promissory note there, but you'd have to make a note that it was forgivable on death if you want to gift it.
Just a reminder for our attendees to please put your questions in the Q&A function. So flipping over to tax changes. So From your aspect, what are some of the recent or upcoming tax changes that farm families should really pay attention to?
This Bear Trust reporting, I think, is going to be important. If you have personal land and it has corporate assets on it, which is a very realistic possibility, that is a Bear Trust. And we've seen a bunch of folks actually kind of with their feet held to the fire around GST in this scenario. But I think for income tax purposes, it's coming. And that's why they're saying, the Bear Trust reporting was originally scheduled for 2025. Now it's been pushed to 2026. But I think that Bear Trust reporting, like gathering that information, your accountant doesn't have all that information. So we have to gather it, get a legal document put together, and then file that extra tax return starting next year. That's one thing that I think is going to be a real pain in the ass for farm families. Oh, sorry for my language. What else? I don't know. The skyrocketing value of farms of the land and stuff, like it just makes that capital gains exemption, which it doesn't really seem like it's keeping up. It makes that capital gains exemption oh so important, and staying on side and making sure that we can gift things at cost. Like all those things have become so much more important because we're looking at such huge values.
Thank you. So it looks like we've come to the end of the questions that we have here with our attendees. So I just want to thank our presenter Edith for sharing some very insightful knowledge with us on succession planning as well as taxing for our farm families to make sure that we can maximize our farms as we pass on to the next generation. I want to thank all of our attendees for joining us and contributing with some great questions. Just a reminder to everyone that this is one of our 5-part series of the Roots to Result webinar series. We do have an additional 3 that will be featured in January, February, March. You can see those on screen, as well as a few other events that Mountable Crop Alliance will be hosting. So again, a thank you to Edith for sharing her insight and information today. I want to thank everyone for joining us today. Please have a wonderful day, and we look forward to seeing you at our next event.